The balance sheet. The balance sheet is one of the three main financial statements along with the income statement and the statement of cash flows. What the balance sheet is and what the balance sheet shows is this. It is a picture in a moment of time at a specific point in time. If you look at the header of the balance sheet, it says balance sheet, the name of the company, as of December 31st, as of March 31st, as of June 30th. It is at a point in time. It's not the day before that date. It's not the day after that date. It is this specific point in time. And the balance sheet shows what the company owns and what the company owes, what they have claim to, their assets, and what they owe, their liabilities and their equity. And we'll look at all of those terms in more detail here in just a moment. But it shows at a moment in time what the company owns and what the company owes. Now, what the company owns and owes is shown in what is called a proprietary theory, or using the proprietary theory. And what this means is that the net assets, assets minus liabilities, belong to the proprietors, or the owners. And so the assets is what the company owns, the liabilities are what is owed to other parties, and anything that's left over belongs to the owners of the company, the proprietors of the company. So the balance sheet, these are the assets, the liabilities, and the equity. The balance sheet accounts are permanent accounts, which means they are not closed at the end of the period, and it means that they have a beginning and an ending balance. Fixed assets, there's a balance at the beginning of the year, there's going to be some increases and decreases, but there's also a balance at the end of the period. The balance sheet accounts are not closed at the end of the period. So last period's ending balance was this period's beginning balance for all of the balance sheet accounts. Now, the balance sheet is made up of three elements, and I've already given the list of them here. We have assets, we have liabilities, and we have equity. We need to talk a little bit more about them. Assets are what the company owns, the things that the company owns. Now, in order to get on the balance sheet as an asset, there's a definition that the asset needs to meet, three criteria. And these three criteria are kind of time-based. There's a past element, a present element, and a future element. So this is the definition of an asset on the balance sheet. It is something that the company currently owns. Okay? That's now. They currently own it. That is going to provide future benefit to the company. If it's not going to provide future benefit, it's not an asset. So something that the company currently owns that will provide future benefit to the company that arose from a past transaction. Okay? Three elements to that definition. A past transaction gave rise to something that the company currently owns that is going to provide benefit for the company in the future. Now, let's look at a couple of assets. Inventory. We bought inventory, we own it, and we will sell it in the future. That's the definition of an asset. Fixed assets. We have a piece of equipment. We bought the piece of equipment. There was a past transaction. We currently own that piece of equipment, and it's going to provide benefit to the organization going forward. Past, present, and future. Now, we have assets of the company that are not recorded on the balance sheet because they don't meet this definition. And the best example of this is goodwill. Now, goodwill is all of that good stuff about a company. It might be a reputation. It might be the brand name. It might be the client list. It might be their distribution network. But goodwill is something that if the company were sold, somebody would pay for. So the goodwill, the brand name, the recognition, that is something the company currently owns. And it will provide future benefit. Either they're going to sell it or we might get customers because of it. But when we're talking about our own internally generated goodwill, it doesn't meet the definition of an asset because there was no past transaction. And in this case, since there was no past transaction, we don't know how much that asset is worth. How much is your brand name worth? How much is your distribution network worth? How much is your reputation worth? No idea, because there was no past transaction to value it. So, internally generated goodwill. Company owns it, and it will provide future benefit, but it's not recorded on the balance sheet because it doesn't meet the definition of an asset. It's missing that past transaction. And it's that past transaction that allows us to tell how much this asset is worth. We know how much the inventory is worth at a minimum because that's what we paid for it. We know what the fixed asset, that piece of equipment, is worth because we paid for it. We have a receipt. We have the transaction. But the goodwill, we have no idea how much it's worth because it arose out of thousands and thousands and thousands of small interactions with customers. So, the definition of an asset, 3 elements. A past transaction gave rise to a present item that the company currently owns that's going to provide future benefit to the organization. You need to remember those 3 steps or conditions or requirements for the definition of an asset. Okay? Because that may be a question, but also because it helps us understand what's not an asset. Because if there is no past transaction, it doesn't meet the definition of an asset. So, that's the definition of an asset. Liabilities has a very similar definition. There was a past transaction or event that gave rise to something that the company currently owes that is going to lead to some economic outflow for the company in the future. Past transaction or event, something the company currently owes that's going to lead to an economic outflow in the future. This is more of an emphasis on the definition of assets than on liabilities, but you need to remember that liabilities has that same 3 points in time definition that assets have. Equity. Assets are what the company owns. Liabilities are what the company owes to other parties. And equity is what's left over, what the company owes to the owners. Now, theoretically, not in practice and not in reality, but theoretically, if we took the assets of the company, liquidated them, settled all of the liabilities, equity would be the amount of money that's left over for the owners. So in a sense, equity represents, if the company was liquidated, how much would be available to be distributed to the owners. Now, I said in theory, but not in reality, because, as we'll see as we talk about financial accounting, some assets are carried at historical cost, how much we paid for it, not how much it's worth. 10 years ago, we bought a building. We paid $2 million for it. It's now worth $6 million if we were to sell it. Well, under U.S. GAAP, that asset is carried at historical cost and depreciated. So on our books, that building might be worth $1 million. We have fixed assets $1 million. But in reality, if we were to sell it, we would get $6 million for it. So the amount of equity on the balance sheet is not actually the amount that the owners would get if the assets were liquidated and all of the liabilities were sold. But theoretically, that's what we're talking about. What is left of the assets after the liabilities have been settled, and that's the amount that the owners are going to have claim to. Now, assets and liabilities are presented on the balance sheet as current assets and non-current assets, and current liabilities and non-current liabilities. The distinction, the way we know whether it's current or not, is this. If it is 12 months or the operating cycle, whichever is longer, that's going to be a current asset or liability. From the standpoint of an asset, if it's going to be used within 12 months or the operating cycle, whichever is longer, it's a current asset. For a liability, if it's going to be settled in 12 months or the operating cycle, whichever is longer, it's a current liability. Assets that will be used, liabilities that will be settled after that 12-month period are classified as non-current. So what's the operating cycle? The operating cycle is the average time between the acquisition of the resources, the inventory, the raw materials, and the final receipt of cash from the sale of that inventory, what we produce. So how long it takes from when we buy the resources to when we collect the cash. For most companies, this time period, this operating cycle, is a lot less than 12 months. It's weeks, maybe a couple of months. But for some companies, shipbuilding, construction companies, the operating cycle might be 3 years. So the definition is 12 months or the operating cycle, whichever is longer. So a shipbuilding company might have a 3-year operating cycle. In which case, for that shipbuilding company, that's what they use as the cutoff for current or non-current, 3 years. But the electronics store that has an operating cycle of 4 weeks, well, they use 12 months. Okay? So it's 12 months or the operating cycle, whichever is longer. That's the distinction between current and non-current. Now, what we're going to do is just list some of the current and non-current assets and liabilities. We'll talk about some of them in more detail separately, but just kind of to understand what these are. The current assets, cash and cash equivalents, receivables, inventory, short-term investments, prepaid expenses, and current deferred tax assets. Okay? Those are the current assets or examples of them. Non-current assets, what we have here, long-term investments, property, plant, and equipment are fixed assets. Intangible assets, long-term receivables, restricted cash, long-term prepayments, long-term deferred tax assets. Okay, those are the non-current assets. They're going to be used in more than 12 months. Current liabilities, payables, accounts payable, dividends payable, taxes payable, unearned revenues, what we collect on behalf of other parties, sales taxes, for example. Short-term notes, the current portion of long-term debt, the amount of that long-term debt that's going to be paid this year. Current deferred tax liabilities. Examples of non-current liabilities, long-term notes or bonds payable, the long-term portion of long-term debt, warranties, long-term deferred revenue, long-term deferred tax liabilities. Now, those are the assets and the liabilities. What do we have in equity? The stock accounts, capital stock, additional paid-in capital, retained earnings, undistributed profits, the profits of the company that have not yet been distributed to the owners. Okay. Other comprehensive income, we'll look at that when we talk about the comprehensive income statement. Treasury stock, non-controlling interests. These are the claims of the owners on the assets of the business. So that's the balance sheet and what's on the balance sheet. What is the balance sheet used for? Well, it allows us to assess liquidity, solvency, financial flexibility, risk. The balance sheet, all these are connected to the same idea. The balance sheet is what we own and what we owe. Well, if your current liabilities are greater than your current assets, that's not a good thing. Because in the next year, you're going to have these current liabilities come due, and you right now don't have enough current assets to settle them. So when we're talking about liquidity and solvency, we're looking at the company's ability to pay their debts as they come due. Financial flexibility. How much cash do we have? What other resources do we have that we can convert into cash to take advantage of some unexpected opportunity that arises? Risk. What's the risk that we're not going to be able to pay our debts as they come due? Now, some limitations of the balance sheet. We already talked about one, but some assets aren't reported on the balance sheet. Internally generated goodwill. It doesn't meet the technical definition of an asset, so it's not on the balance sheet. Also, I said connected to that, we have assets measured at historical cost. That building we bought 5 years ago, it's appreciated in value. But what we paid for it 5 years ago is what's on the balance sheet. And also, maybe the biggest, within the balance sheet, there are a lot of judgments and estimates made. We estimate bad debts when we value receivables. We estimate the useful life of our fixed asset. We estimate the warranties expense that we're going to have and the liability that we're going to have. Accounting policies, whether we use FIFO or LIFO, is going to impact the carrying value of our inventory. So the balance sheet isn't perfect, but what it is it is a picture at a moment in time. What it is that the company owns, what it is that the company owes to other parties, and the claims on those assets of the company that the owners have. The assets, the liabilities, and the equity. Okay? You need to know what's the definition of an asset, what's the definition of a liability, and what that equity represents. But the balance sheet, one of the three main financial statements, and it is a picture in a moment in time. Not the day before, not the day after, but whatever date is there, it's what the company owns and owes to outside parties and to the owners.